And well, let me welcome everyone. My name is Tim Leung. I'm the director of the University of Washington's Computational Finance and Risk Management program. It's a master's degree program, and we have had the pleasure that John Guerard, today's special guest speaker, has taught for us for multiple courses in the past. And like I said, it's extra special for him to give us a guest lecture today. John really, need no introduction, but I'll try because I'll also share your bio with all the students so they have seen the sort of the long form bio as well. So John has spent decades with McKinney Capital Management, and now he's currently the director of Pacific Spirit Investments, right? Used to live in Alaska. Now he's living Bluffton, South Carolina, right?
Exactly.
Yeah, and over many years, he has taught in multiple programs, including Rutgers and CFRM, and been involved in publishing many books and collaborating with many well-established researchers. It's really well known, and even I have our student have published in one of his volumes that he edited over the years. I have also shared John's article with our students on Canvas, our course management website. And so they should know a little bit about your work. And today, you're going to talk about portfolio selection using ESG data. And we are glad that our CFRM program has helped kind of contribute to your research as well. And can't wait to hear more about it. So without further ado, I'll let John give his presentation.
Thank you, Tim. First of all, it's a great pleasure to be back at the University of Washington to be able to share our updated results. I taught the 502 and 509 classes in 2020 and 2021. It was a great experience. I love the financial ethics course. It's what we would commonly call a socially responsible investing ESG course. And so what we're going to do today is present a statistical review of the KLD database. Now, the KLD database, the Kinder, Leidenberg, and Dominy database, was the premier database for SRI investing since its creation in 1991. It really ceased operation. It was bought by Morgan Stanley, and the database itself has not been repopulated since 2017. So we're going to show you an analysis of 1991 to 2017. And this is exactly the similar analysis that I did 4 years ago with our CFRM 509 class. All of our students had a project. Now, one thing that's going to be important, and I want to say this at the beginning, the CFRM program is an excellent program. It's a top 15 program nationally. Tim has done a great job. Karen was extremely helpful. And the founder of the program, Doug Martin, and I just published a paper about a year ago. So after my class ended and we moved on to other research projects, Doug Martin and I took the CFRM database and we took out the SRI components of it. And we did a full Russell 3000 component analysis. So what we want to talk about today are 3 or 4 things. Tim, if you can advance the slides, please. Okay, let's see. Okay. Here's what we're going to do. We're going to talk about 3 takeaways from today. First of all, what's important about SRI ESG is the researchers should be very familiar with the Moskowitz Prize. If you're doing research in SRI, the Moskowitz Prize was created in 1996 to honor people doing outstanding research in socially responsible investing. I was fortunate enough to be named the first winner of the prize in 1996. And my office mate, with whom I shared an office for 18 months at the University of Texas, just won the 28th award. Laura Starks, who was president of the American Finance Association 2 years ago. So if you're doing research in SRI ESG, you should be familiar with the Moskowitz Prize. Milt Moskowitz was a publisher, and he did Working Girl, and he made fortune, and he basically dedicated the Moskowitz Prize to the memory of his wife. And so we want to be aware of socially responsible investing. It's not just good, it's smart. And we're going to show you why it's smart. We're also going to talk about today, there's many different models that we can use for stock selection. I've always been a believer in the Graham and Dodd low PE approach. And so I always believe that earnings should be in any valuation model you're making. Remember, we are quant. And so we're going to have a low PE approach. We're also going to look at forecasted earnings revisions. Whenever we do a regression analysis to estimate the variables as they affect stock returns, we want to be sure that we're using robust regression. I was using the Beaton-Tukey bi-square approach 30 years ago when I was working with Harry Markowitz, the Nobel Prize winner. We found huge issues with outliers. Doug Martin, who has written a great book, one of the definitive texts for John Wiley on robust regression, says, let's take a look at it. And what Doug Martin and I did from 2021 to 2024 was completely verify what we had done. And in section 5 of our paper that came out in the Journal of Portfolio Management, it was important because we updated everything and we showed that there were statistically significant problems with outliers in the Russell 1000, the Russell 2000, and of course, with the Russell 2000, the smallest stocks, we had even more outliers than we had in the Russell 1000. We're going to talk about databases today. When I was at Washington, we used the WRDS, Wharton Research Data Science Data Services database of CompuStat, balance sheet and income statement data, CRISP, the stock returns, and the IBIS database, earnings forecasts, analyst forecasts of earnings, the revisions, and the directions of earnings revisions. So we're going to be talking about KLD and a separate database as part of the WRDS services. So, Tim, please advance the slides. These are our 3 takeaways today. I'm using a modified approach that I used in April of 2021, right at the end of my course. Chris Gacy and I gave a paper together on SRI ESG. Chris Gacy, you may not know it, but he is the distinguished adjunct faculty member at the Wharton School, and he is a runner-up for the Moskowitz Prize. I won it in '96, finished runner-up in 2000, and we gave a paper together 4 years ago that was published in one of the Wharton School books that was published by Oxford University Press in 2023 on SRI ESG. So we're going to modify some of these slides and show you what we were talking about then and what we're talking about now. First of all, we will be using SRI ESG challenges in the context of a Markowitz mean variance analysis. We are concerned with portfolio selection using mean variance analysis. We all know that the utility functions are approximately quadratic in the long run, but mean variance does not necessarily assume a quadratic utility function. But you have a quadratic utility function is a very good approximation to portfolio selection. We are concerned in this presentation with 3 items of portfolio selection. We want to maximize the geometric mean. We want to maximize the Sharpe ratio, which is, of course, excess returns relative to portfolio standard deviation, the Sharpe ratio, and the information ratio. We're maximizing the excess return relative to our tracking error. So we're going to be concerned with maximizing the Sharpe ratio and maximizing the information ratio. Let's advance the slide, please, Tim. Okay. One more, please. Okay, thank you. We're going to be talking a lot about the environment today. Now, here's what's really important about SRI ESG. If you look at these slides that we presented, and the reason we're showing you these slides again, most SRI ESG investors are concerned with the environmental impact of SRI ESG. If you look at it, that's the 3rd largest important factor, is the environment. What we're going to show you today is the environment is important. However, from the point of view of maximizing the Sharpe ratio and maximizing the information ratio, the environmental variable is a 4th order effect. A 4th order effect. We're going to find far more important ratios KLD variables that influence stock selection. We're going to show you that the product variable, which is a surrogate for R&D intensity, is very important. We're going to show you that human rights having to do with indigenous people is a very important relationship. We're going to show you that diversity, having minority women CEOs are very important. And all of these together in a big KLD all variable is the most important variable yet. So when we're looking at the environment, keep in mind the environmental factor is one of 9 KLD criteria, but it is not the most important for portfolio selection. Just advance the slide, please, Tim. Okay, now ESG has a bad name, and I don't know why it does. People believe that if you're a do-gooder, a tree-hugging liberal person, as many people like to categorize ESG, SRI investors, that's not a valid consideration, a valid criteria at all. And I can tell you why. The characterization is completely wrong. Yes, Democratic secretaries of labor approve of SRI, and Republicans, you know, Eugene Scalia had a very important father uh, who was quite renowned justice. Uh, he didn't care for SRI, but I can tell you this about SRI. We are going to show you that when you eliminate firms that have bad records on the environment, bad records on indigenous people, and bad records on corporate governance, those firms you want out of your portfolio because they're going to drag down the return in some cases, but primarily when you eliminate firms with those bad characteristics, you end up substantially reducing the standard deviation of your portfolio. You reduce both the standard deviation and the beta of your portfolios. Hence, your Sharpe ratios and your information ratios rise dramatically. And that's the real key to being an SRI ESG investor, knowing that you're reducing risk, you're enhancing the risk to return ratio, the return to risk ratio, and your Sharpe ratios and your IRs are rising. Next slide, please. Now, if you simply looked at all the portfolio and all the mutual funds, and you went to the CRISP database and you looked at mutual funds, you would find that the intercept for the SRI funds is slightly larger than the non-socially responsible investor funds, but there's no real difference on the FAMA French 3-factor or 4-factor models. So there's no real difference at all between SRI and non-SRI mutual funds. They perform relatively the same. My paper in 1997 that won the first Moskowitz Prize award was entitled, "Is there a cost to being socially responsible in investment?" And the answer I gave in 1997 was no. The SRI model that we had, as opposed to the non-SRI Russell 3000 portfolio, had a difference of 7 basis points. 7 basis points, which was not statistically significant. So SRI is going to give you very similar results to non-SRI, but when you do it properly nowadays, you're going to find that the standard deviations are substantially reduced by SRI. Next slide, please, Tim. Thank you. Okay, so what we're going to be talking about we're going to show you the results that we did for the environmental case, which was the E and V variable, which is what we did for our 2023 paper. Why? Because that's what people were primarily interested in, and we wanted to show them how performance would work. Next slide, please. Okay, we have to have models of expected return. Now, for any of my alumni that may be on the call from FRM 502 and 509, or anyone that's read my papers that I've contributed down through the years with Harry Markowitz, knows that I believe in robust regression, and I believe that there are a seemingly infinite number of models that you can use. However, I have used 3 models, actually 4 models in particular, for the last 30 years. Those models are a CTEF subcomponent that looks at IBIS forecast. So CTEF is a composite model of IBIS forecast and revisions. The user model is a 10-factor model that's been around for 30 years. looks at earnings, book value, cash flow, and sales relative to price, the CTEF variable, and the price momentum variable, and relative variables, how earnings and book value, cash flow, and sales move relative to their prices. So there's a 10-factor model. And we used robust regression to weight it over time. We could also look at an equally weighted 10-factor model or an equally weighted 8-factor model or some components of that. But we're going to be looking at the user model, which we will affectionately refer to as REG10 for today. Next slide, please, Tim. Thank you. Okay. Now, I talked about Harry Markowitz. I worked for Harry actually before he won the Nobel Prize. He hired me in February and he won it in October of 1990. And there's no cause and effect by that. I'm under no illusions of grandeur, but in February of 1990, Drexel Burnham Lambert went bankrupt. I was working in the quant group at Drexel Burnham Lambert. I interviewed with Harry Markowitz on a Saturday morning at the Grand Central Station Oyster Bar. Harry hired me after a 2.5-hour interview that day, and I flew back to Chicago and joined him 6 weeks later. So when we would talk about portfolio theory, I always believed that there must be Markowitz mean variance optimization. You need to take into account the ITG cost curves, which we did. We took, first of all, our CTEF here. And what we did was we said, all right, let's create a CTEF portfolio for a 15-year back test. This was in the Russell 3000 universe. We published this in a special issue on SRI investing at the Journal of Investing in 2020. We published a paper, and Elroy Dimson published a paper, and there were 3 papers in the special sub-issue that were really, I thought it was a lot of fun and a great issue. So let's look at our KLD criteria in this chart. So this is a chart that we did from 2020. Yes, thank you. And we looked at special concerns. We looked at the concerns for corporate governance, GCOV, for community relations, COM, for diversity, DIV, for the environment, ENV, human rights, HUM, product, which we said was a surrogate for R&D, PRO, and total criteria. And if you look at the annualized excess returns, you see that primarily human relations, human rights, and total screens in the third column cause your annualized excess returns to rise. But notice one thing that's important. Notice the portfolio annualized standard deviation. The portfolio standard deviation of CTEF is 21. And as you put the ESG factors with the expected return model that we're using, CTEF, it was 70% CTEF and 30% your KLD factors. What happens? The standard deviation drops dramatically. It goes from 21 to about 17 to 18%. What does that mean for your information ratio and your Sharpe ratios? Well, as you reduce your portfolio standard deviation, notice your Sharpe ratios rise from 0.61 up to 0.75. So the variables that produce the highest Sharpe ratios would be the total KLD factors, human rights factors, HUM, and product screen, PRO. So those 3 factors were most important, and then ENV comes along at 0.65. So it's a little bit, so it's a 4th order effect at that point. Notice in terms of information ratio, you have the same types of rankings. Notice the tracking error goes down substantially, hence the information ratio rises. Next slide, please. Thank you. So let's now define the factors in the REG10 or the user model. Earnings, book value, cash flow, and sales. If you were a Graham and Dodd investor in 1934, you would say yes, particularly EP, and you would be excited. And if you were familiar with the IBIS earnings forecasting work of Elton, Gruber, and Gultigan from 1981 that started a whole plethora of hundreds and hundreds of earnings studies using the IBIS database, which is now part of the Orton Data Services, WRDS, you would say earnings forecasts, earnings revisions, and directions of revisions are most important. CTEF is an extremely influential component that we developed 15 years ago, and it's served its purpose very well for our research. We use a traditional form of French price momentum 12-1 in this analysis. Next slide, please, Tim. Thank you. Now, this slide is too small for you to see with any type of real world application. But if you look at your intercepts from your FAMA French models, with the FAMA French one factor model, you have an intercept of 3.3%. That's on the left side of your column. The one factor model, the CAPM, the intercept is 3.3. And as you go through the different models, you see that the user model has a 3.3% excess return with an intercept. That's statistically significant. All right. If you look at the five factor model, the intercept is still 3.3. The reason that we wanted to concentrate on the one factor model and the four factor models are that those were known about the time that we were working on our expected returns in 1997. The five factor model pops out in like 2010. We don't want to use a risk model that was known in 2010 if we're looking at portfolios from 1997 to 2017. Why? Because as Harry Markowitz says, we always want to use models that were known and published, and the databases were available for researchers at the time they were doing their analysis. So we're going to be showing you simulations from 1997 through 2017, today, 20 years of KLD databases. And these models are going to be out of sample post-publication. And that's why we're using the 1 and 3 factor or 1 and 4 factor models. So let's advance the slides, please. Okay, now what do we want to find? We want to show you that with the case of the environmental scores, if we buy factors that look good on a high user score, and we also buy stocks that look good on a KLD criteria, and we look at the spread between the high environment and high user score and the low user score and the low environmental score, the spread is substantially, well, it's statistically significant. So we have a nice spread of 3.5% with both the one factor and the four factor models. These are looking at the spreads in these variables. So this is what we published in 2023 in the environmental paper that we published. And by the way, Laura Starks, my old office mate, also published in that issue. And she was then the reigning Moskowitz Prize winner. Next slide, please. Now, let's start talking about the year of our Lord, 2024. And by the way, I'm trying to steamroll through our presentation because I want to reserve the last 10, possibly even 15 minutes for questions. So let's talk about the KLD database. And we want to look at, first of all, we don't have KLD database unless we have an expected return model to work off. So let's look at the Russell 3000. This table of the Russell 3000 has been published in two papers that it's gotten kind of, the paper that's cited at the bottom is available for you. And I'll make sure that you have that paper. But notice the low PE approach, the high EP approach has an IC of 0.029 with a t-value of 6.39. Notice the forecasted earnings IC, this is on table 6, has an IC of 0.04 with a t-value of 7.55. CTEF has a t-value of 7.62. This is for the overall CRISP universe. And if we regression weighted, we could get an IC of 0.029 as opposed to an equally weighted IC of 0.017. So we want to do regression weighting. Pardon me. And notice this, as we move to the Russell 3000 universes as opposed to the Russell 1000, our ICs go up and our t-values rise dramatically. T-values go on the low PE approach from 3.3 to 5.3. And with the user model, we go from 2.5 to 4.5. Keep in mind when Campbell Harvey was talking about our data mining, he wanted t-values exceeding 4. 2 for statistical significance, but 4 for Campbell Harvey. We've given him his t-statistics he's looking for with these. Now, when I taught 502 and 509, we always talked about the 8-factor model, the 9-factor model, and the 10-factor model. And as we look at REG 8, the overall IC for the 40 years of information coefficient is 0.021. You see under predicted on table 15 with a t-value of 4.1. If instead of using historic earnings, we used a predicted earnings, our IC goes from 0.021 to 0.033 with a t-value of 5.75. I get excited about t-statistics. T-statistics are like anything else. The larger, the better. And so when we want to have large t-statistics. Notice with REG9, our IC goes to 0.039 with a t-statistic of 7.24, and REG10, which is user, 0.052 with a t-value of 7.98. When I worked for Markowitz and we ran our Japanese model from 1991 to 1994, we beat the market by 3,000 basis points. That was using REG8, which was a pure, robust estimation of value factors. And in Japan, over the last 30 years, REG8 still reigns supreme. In the US, where earnings forecasting is far more important, REG10 is a better model. And we identified REG10 back in 1997. Now, next slide, please. Okay, thank you, Tim. Now, here's what I want to show you. If we look at, this is Exhibit 3, this is from an invited paper on ESG integration with 4 of my young quants from Georgia Tech. After I taught the 509 class, I also taught an independent study at Georgia Tech. 3 years ago, we published a paper in 2023, and we're in the process of publishing a second one because we were looking at primarily climate change in our paper that we published last year, which I'll make sure that you have a copy of. But now if we look at the top 10 Sharpe ratio strategies of ESG of all models, we see that the REG10 is the best. Diversity has a great Sharpe ratio. The Sharpe ratio is 0.75. Diversity is important. Product screen is important. This is with REG10. The most important variable with REG8 is an environmental variable. And so if we're looking at these, most of our 10 top strategies, most of them come from the REG10 model, a couple from the REG9, and one from the REG8. So it's important to look at all 3 of these models. Next page, Tim, please. All right. Now, so let's look at REG8 from 1997 to 2017, 20 years. And what do we find? If we did not have any KLD screens, we would have a Sharpe ratio of 0.53. If we use all of the 9 KLD criteria, you see that the Sharpe ratio rises from 0.532 to 0.643. So this is the 8-factor model. So as we look at the 8-factor model, notice the one that drives the process for the most part are all the KLD screens. It has the highest Sharpe ratio and the highest information ratios. Now, for Ken Blay, my good friend from industry, you'll notice that the tracking errors on these REG8 models are in the neighborhood of 13 to 18%. This is value only, and value has not worked terribly well in the US the last 20 years. And so we want to be aware of this. But notice we're using our KLD screens all up. So let's go now to the next page, please. And this is REG9. So now we're admitting not only the 8 value variables, but now we're also admitting our IBIS CTEF variable. And what happens? If we look at the Sharpe ratio for no KLD, it's 0.606. But as soon as we let the all variables come in with REG9, the Sharpe ratios go to 0.68 to 0.74. And with the product screen at the bottom, I've highlighted the dark ones that are the most statistically significant ones. You'll see that the Sharpe ratio is 0.68 to 0.76 with just the product screen. And you'll notice that the annualized returns are good. The tracking errors go from 16% or 16%. Some of the tracking errors fall as low as 11%, but you do need to have a substantial tracking error to make these variables work. And the problem I have is many people want to talk about SRI, ESG. They don't have a good stock selection model, and then they want to use a small tracking error. There is no way in the good Lord's world that if you have only an index hugger and you're using a 2% tracking error, you're never going to get any benefits to SRI. You need a highly statistically significant stock selection model, the REG 8s, 9, and 10s, primarily REG 9 and 10, and you need to be able to have higher tracking errors in the neighborhood of at least 6 to 8% of targeting tracking errors. Information ratios are much higher with REG 9. Next slide, please, Tim. All right, REG 10, which we believe is the best model. Notice now the tracking errors are down substantially. Why? Because it's a better model and it has higher Sharpe ratios and higher information ratios. So if we look at this variable and we allow all factors in again and the product screens again, we see that's where we maximize the information ratio and the Sharpe ratio. We maximize the annualized excess returns. Notice the environmental variable has a Sharpe ratio of 0.9. The Sharpe ratio for the environmental variable with 0.64 is 0.68. That's less than the all of 0.71. It's less than the product screen. The environmental variable has a good Sharpe ratio, but it is less than the product screen. It's less than the all variable. You're going to see something called ECM in this table. And you know what we're doing with the ECM in table 3? We're bringing back my 1997 model, where we had only the military screen, we had the corporate governance screen, and we had the environmental screen. So that's the ECM screen. And notice that the Sharpe ratio and the expected returns are a little bit down with that, but notice that the Sharpe ratio, because the Sharpe ratio is as high, if not higher, than the KLD screen, is actually higher. Why? Because the standard deviation has fallen so much. It's gone from 22.4% to 18%, which means that our Sharpe ratio has gone from 0.61 to 0.68. So as we look at these variables, what we want to show you, whether we're using all, whether we're using the product screen for R&D, whether we're using the environmental screen, whether we're using human rights screens, notice our Sharpe ratios and our information ratios are rising. And that's very important for us. As an SRI investor, we need to make a convincing case that what we're doing is implementing models such that the Sharpe ratios and the information ratios rise. Next screen, please. Okay. And if we sort all these variables by the Sharpe ratios and you go down, you see the product screens, and you see the all screens, you see the ECM screens, and these are the ones that come down. The environmental screen is down there with about halfway down the page. So we believe that KLD does add value. We believe that it enhances returns. It produces better Sharpe and information ratios. That's why we had our paper in 2020. We said, warning, SRI, ESG investing may not be hazardous to your Sharpe ratios and your information ratios. We were being tongue in cheek. Why? Because we believe that institutional investors that know the difference want to make sure that their products have the highest information ratios and Sharpe ratios they can. Next slide, please. So what have we done? We've updated our work. We've used the Wharton research databases of CompuStat, CRISP, and IBIS. We've built 4 statistically significant stock selection models. We've shown you that the environmental variable is important, but all KLD screens and product screens produce the highest Sharpe ratios and information ratios. Over the 20 years, not only out of sample, but post-publication. Yes, indeed. And if you're a fiduciary and you have to stand by and tell your clients, yes, I'm looking after your best interest, the highest Sharpe ratios and the highest information ratios are going to give you that criteria. Tim, can we advance it? Okay, a couple of references. You can never read enough Harry Markowitz. And so if you're starting at the beginning, in the beginning, there was the word, and the word was Harry Markowitz in 1959. So in 1952, he writes his paper. In 1959, he writes his book. Jan Mawson, that taught me my uh, doctoral seminars at the University of Texas, was one of the three developers of the capital asset pricing model, and that's a great book. And then the other book is the foundation of basically the Nobel Prize lectures of 1991 from the CFA Institute. And that has all the original issues. So at that point, the rest of the reading list is just available. You will notice the one at the bottom, Doug Martin, John Guerard, and our friend Dan on reconstructing E to P with robust controls for outliers. Final slide, please. Thank you. And that's what we want to talk about. That's what we wanted to talk about today. I've tried to save time for questions. So Tim, thank you. And I'm willing to take all questions.
Thank you, John, for the presentation. Yeah, you leave us some time for questions, so let's open it up to the floor. Anyone, I guess you can raise your hand, or you can text, send a message. I can read out for everyone, and then John
Please
can
do.
Yeah.
Tim, that's perfect.
Let's see in the chat here. Or
Let
you
me
can,
ask a question first. Let me ask a question and then answer a question first.
yeah.
First of all, if I were a state retirement system, like state of Washington, state of South Carolina, state of Georgia, state of California, CalPERS, CalSTRS, would I be doing SRI? And the answer is yes. I would because of the Sharpe ratios and the information ratios. But here's the thing that's most important about that. I'm not saying that SRI ESG should be 100% of your portfolio. No way. However, it would make sense that your SRI ESG portfolio should probably be, if you had a portfolio that was composed of four SRI, if you had a portfolio that was composed of four mutual funds, at least one of them should be an SRI ESG fund. The CREFT, TIA CREFT, Social Choice Fund was a great fund for many, many years. And when I was working with the Moskowitz Prize analysis, we always cited the TIA CREFT Social Choice. Why? Because it was a fully quant managed SRI fund. And it had very good performance. It did not suffer relative to the S&P. So I'm not saying all of your investments should be SRI ESG, but clearly 25 or 30% of it would not hurt you to be an ESG investor. And most people probably wouldn't think of that in that context. Now, I'm sorry, Tim, back to you.
Sure. I actually have a question, and
Sure.
and also it looks like we have. Yeah. Let me. Do you want me to close the slide so that we can see your face bigger?
Yeah, please.
Yep, maybe do that. Yeah. Okay, perfect. So I have a question. So you of course you use ESG, right? SRI database, and you mentioned ESG scores. That's one of the ways you kind of come up with the the factors and end up with using it for portfolio selection. My question is how robust is the approach or the model, right, with respect to the ESG score? Because as you know, and then we've covered in this class, there are multiple vendors of ESG scores, right? And they all
Yes.
have different formats. Some of them are 0 to 100. Some of them are kind of like credit rating. So how robust is your approach to the different styles, the different vendors of the ESG scores?
Well, let me put it this way. I think that's an excellent question, first of all. Thank you. That's a great question. KLD, the reason I like the KLD database so much was it specifically laid out the concerns. For example, it told you what the criteria were. Corporate governance was dependent upon primarily executive compensation. That was one of the big goals, and whether you had to pay fines as a result of political chicanery and bad actions. Human resources, the human resources thing was based on indigenous people. Diversity had to do with women and minorities being CEOs and being promoted. Um, the environmental variables were how much you paid in EPA fines primarily. So there were very objective criteria, and they would have concerns, and they would rate it on a scale of 1 to 5 for concerns and strengths. And so the KLD database was a very excellent database, and that's why it was so popular for so many years. Unfortunately, Morgan Stanley bought it. Morgan Stanley bought it. First of all, my friends Peter Kinder and Amy Dominy and Leidenberg did very well for themselves, and so they all retired to their front porches and sit in rocking chairs now. And every year, I get an email from them saying, "We're still here and we're enjoying our life even more. Uh, Keep doing research on SRI ESG." And so, they're still practitioners in it because Amy sits on the investment committee of the Episcopal Church for doing her SRI ESG work. But the vendors are very different and the criteria are very different. Most people nowadays, some of the criteria are very difficult to read, and I understand that. And that's why in my research, I always use KLD as the gold standard. But we've had to use other databases in the industry, and you make it work, but the robustness is not nearly as good as what KLD was,
Uh-huh.
and that's a huge issue.
Hmm. Let's see if anyone have other question. I have one more kind of follow up. Maybe I'll ask that while people coming up with people come up with questions. In terms of the I'm interested in the time relevance of the scores. So for example, you mentioned the environmental side was how much EPA fine, right, a company has paid, right? But
Right.
does it look back all the all the years in the past, or it's just like past like 5 year window or something, right? Or past year?
It's usually a 3 year window. Yes, it's usually a
Yeah.
3 year window. Now, let me tell you a story though, Tim,
Mhm.
that's extremely relevant for that. In 1997, I had a good friend of mine who taught economics at Columbia University, Phoebus Grimes. He's one of the great econometricians of all time. So he had been a professor at Harvard and at Wharton and taught the last 40 years of his life at Columbia. He was an econometrician. And so he was invited to do a KLD study. So he called me up and he says, I need somebody to help me with the KLD database. So I was his research associate. And
Mhm.
so we went through and I told him what I was doing and how I was doing it. So I prepared the database for him. And we did an analysis. And in 1997, the product screen and the all screen were the most important screens in the database in 1997. And they continue to be the same across time. And here's why. Firms that paid significant fines for EPA continue to pay significant fines. Most of the firms do not change their stripes. Firms that are bad on an environmental basis in 1997 continue to still have issues. And so
Mhm.
while there's a time concept to it, I could use, and we've done this before with the Georgia Tech paper. We froze the criteria in 2017, and we allowed those same criteria to keep going through 2023, and we found that those criteria were still robust and delivered the same excess returns. So
Mhm.
the databases are very, very um, costed over time.
Yeah. So
Karen,
how
did you send me a question?
no, she just want me to
I did.
close the slide. Oh, directly to him. Perfect.
Go ahead, Karen. Ask me a question, please.
Oh, I just was asking if KLD is now owned by MSCI, and I was looking at the MSCI KLD 400 Social Index and just wondering what your thoughts might be about that document, which I posted in the chat to you.
Okay. I have to tell you, that database, that mutual fund, the 400, the S&P, that KLD 400,
Mm-hmm.
that data, that mutual fund strategy was created in 1992. In May of 1992, it was the oldest criteria that they had.
Okay.
And what they said was, here's what they did. They took the S&P 500 and they threw out 75 of the most outrageous violators of the KLD criteria, primarily having to do with corporate governance and environment. And then they put in a couple of smaller firms that were high beta stocks that were very aggressive, high growth, R&D intensive firms. And they put those in and they said, we're going to match. We're going to take this S&P and we're going to look at it relative to the KLD 400. And it has performed as well as the S&P 500 over basically a 30-year period. And what's remarkable about that is that, 80% of the managers have not beaten the S&P 500 probably 90% of them hadn't beaten the S&P 500 the last 30 years. Well, KLD has been as good as the S&P, so that means that KLD has probably beaten 80% of the active fund managers. So that was a great portfolio. It continues to be a great portfolio. And it grew in size. It used to be 100 million. The last time I looked at it, it was $5 billion. So it's done extremely well. So, Amy Dominy is a very happy young lady. She was the product manager for years and years and years on it. But, the KLD variable that you're talking about, that mutual fund, is basically using pretty much the same variables that you can find from the social choice from TIAA-CREF. So if you're an academic at the University of Washington, some randomly selected top 15 school in financial engineering, and you say, I want to be an SRI investor, buy the social choice fund. It's done extremely well. Now, I will tell you this, there is one problem with SRI ESG, and it has to do with tobacco. And here's what I'm telling you. If you take the 30-year history of SRI, when SRI underperforms, it's when tobacco prices are rising. And for whatever reason, you get hammered on tobacco. When SRI underperforms, it's invariably because of tobacco. That's something I've noticed. And given that I just had my 50th reunion at a college that was financed by American Tobacco Company, Duke University, I don't criticize tobacco very often. I had a scholarship there, so I'm very happy to say that, I'm a proud supporter of Duke, and, tobacco did a lot of good in terms of helping education over the last 100 years exactly.
Mhm.
So, your question is very good about the KLD mutual fund. It's been a great fund. Other
John,
questions?
a question from one of our students, Michael. He asked to you, what are some of the questions of ESG or SRI that you're still actively investigating, perhaps other than portfolio selection or maybe involving portfolio selection? Or do you think there should be any effort to come to consensus on how criteria should be used for ESG or SRI?
That's an excellent question. And let's take that question a step further. Right now, the most pressing question facing SRI ESG is whether states are going to outlaw your state pension funds from doing ESG investing.
Mhm.
There are many states, in fact, I live in one, that want to outlaw ESG SRI investing. So I have written my state senators, both of them. They haven't responded, but they don't respond to a whole lot anyway. What people need to be aware of is that there are many state governments, many state attorney generals that are trying to press the case against SRI and ESG, and it's simply wrong, and it's simply misguided, and they're completely unaware of the facts. And that's the biggest issue. SRI needs to be continued. You know why you need to continue the research? Because you need to show that active management within SRI ESG is important. There are enough people in this world that believe that everybody should be a closet indexer. I don't want closet indexing. Do you want your daughter to marry a closet indexer? Only if he has 500 billion in his fund. For the most part, I believe in active management. I did with Markowitz, and we showed that it would win. And our work with ESG showed it could win. Our work with small stocks, international stocks, and emerging markets said that all showed that active management could win. You just had to have a good stock selection model, and you had to execute it to the full extent that you could. And it required a tracking error of 6 to 8% to win. So I think that's the most important issue, is making sure that state governments, state retirement systems don't outlaw ESG SRI, because that's a huge drawback. Other questions, please.
Yeah, anyone else?
Well, Tim, before I sign off, I want to congratulate you on your forthcoming World Scientific Publishing book. You're getting ready to do another WSP book.
Yeah.
I edited a book with Bill Ziemba, my friend at University of British Columbia. You contributed a chapter to that. That was much appreciated. And just 2 days ago, I delivered my chapters for my Oxford University Press book, Financial Forecasting. So it's coming out in English by Oxford University Press, and it should be coming out in Chinese by Peking University Press. We submitted it to Peking 7 years ago. They've been translating it for 7 years. I suspect it'll come out the week after the Oxford University Press book comes out.
We'll see. Well, I would love to put my hand, get a copy of that. Or both.
Yeah, I'll certainly make sure that you do. So I encourage you, please, to make sure that the papers that I sent you are available for all your students. And I will also send you, for the students, for your alumni club that took 502 and 509 with me, I will send you my copy of the Applied Corporate Finance book, the 3rd edition that came out in 2022. And we used a lot of that book. We used about half that book for 502 and 509. So I'll send you that, and you can make that available for the alumni club and the current students. Anyway, thank you so much for your time, Tim. Karen, wonderful seeing you again. Thank you, folks, my friends from industry, colleagues. Thank you. I appreciated being able to participate. Thank you very much.
Thank you, John. Thank you, everyone.
Thank you.